The calendar straddle. One position hedges the other. The calendar straddle is an option strategy formulated to earn profit when low price volatility is present in the underlying asset. It is also called a delta neutral option strategy. The calendar straddle is a combination of both a short-term straddle and a long-term straddle. The trader sells the short-term straddle and buys a long-term straddle with this objective: to realise a profit due to the slower rate of time decay on the long-term straddle compared to the short-dated one. Since short-dated options decline in value more rapidly than the longer-dated ones, the difference becomes your profit. A calendar straddle is also known as a horizontal spread because the trader sells option contracts that expire on one date while buying other options expiring on a later date. You're also looking to take advantage of the differences in the option's implied volatility for different expiration dates. As a trader, you should aim to use this strategy when you can purchase the longer dated options at a relatively cheaper price than the shorter dated ones that you're selling. The best time to create a calendar straddle strategy is when the price action of the underlying stock or other asset is expected to remain stable in the short term, but in the longer term should break out to make a more significant move. With calendar straddles, all your options should have the same strike price. So let's see how the calendar straddle profits. This type of trading is mostly done by experienced option traders because profits can be achieved in two different ways. Firstly, from the higher rate of time decay on the short-dated options compared to the long-dated ones, and secondly, through a secondary profit realised by the longer-dated straddle following a reasonable price movement in the underlying. The calendar straddle is appealing because it has the ability to profit when the price action of the underlying asset is stagnant. It also offers flexibility to the trader to cash in on the long-term straddle when the stock price has moved significantly. It also has limited risk, with no margin required to hold the trade. If you expect the value of the underlying to move significantly shortly after expiration of the short-dated options, either weekly or monthly, doesn't matter, then you can allow the short-dated straddle to expire and keep the credit, then wait for the long-dated straddle to profit from the price move. If you believe the price action of the underlying will remain stagnant, then once the short-dated options have expired, and assuming that your long-dated options expiration is still a few months away, you may wish to sell another short-dated straddle position and receive more income if you think the conditions are right. The profit associated with this trading technique is limited in the short term, but can be huge in the longer term. Losses are limited to the net debit to your account after you have subtracted the credit you receive from the short positions from the cost of the longer dated straddle. So it's possible that when you write your second straddle, the credit from your short trades will be more than the cost of the bought position. Using risk graphs, you can determine your expected profit levels. The one below gives you an idea of what a calendar straddle payoff diagram looks like. The payoff diagram for the short-dated sold positions looks like this, while the longer-dated bought positions look like this. Calendar straddle strategies provide a great opportunity to benefit from stocks with consolidating or stagnant price action or in a trading range. The only disadvantage is that profit potential is limited up until the expiration of the sold options. After that, if you're lucky, the price of the underlying could explode and the implied volatility in the bought straddle options might balloon so that theoretically, profit potential could be unlimited. The calendar straddle, or neutral option strategy, is an advanced option trading strategy. It is simple to implement, and the only variations might be how far away you choose for expiration of each of your straddle positions. The determining factor should be the implied volatility in the options. Doing it right, calendar straddles can give you a stable income with minimal risk.